Hi, welcome back. Well, just wanted to point out on a couple of stocks. CG Power is one stock that has been really rough, volatile actually. Today is a good day for CG Power, 7% higher. You reckon that it could be perhaps just, after the big moves we've seen on the downside, some short covering?
I think some short covering. It fell 30% yesterday on the same news which was already reported. Yeah. So perhaps today is a day of just taking out those shorts. Could be interesting if it hits the 10% first circuit, though, Sonia, because that would lead to further short covering. Right now, up about 8%, of course, on that stock.
Okay, well, let's move on. Arvind Fashion, which is the demerged entity of Arvind and contains the branded and retail business, will list in a few weeks' time on the stock exchanges. Kulin Lalbhai, the executive director of Arvind, joins us now. Kulin, hi, good morning, and thank you for waiting by patiently. Can you just start by telling us in terms of a timeline, when will the listing be? And now that you can speak a bit more about the numbers, what kind of a growth can we expect over the next 1 to 2 years for Arvind Fashion on the top line?
Yes, we are expecting the demerger over the next few weeks, so it should be happening in the month of February itself. On growth, in Q3 also we had industry-leading growth, where overall growth was 24%, but in our two big segments, which is our power brand segment and specialty retail segment, we actually grew by 28%. So I think the portfolio is doing very well. It's in the sweet spot of the casual youth structural, growth market. And we are expecting, because we have a lot of runway still on growth, both through channel expansion and category expansion, I think growth momentum should continue in the years to come.
Okay. Good morning, Kulin. Always a pleasure. Can you tell us what is the contribution of each of those segments, power brand, specialty retail and emerging brands, to revenue and EBITDA?
Yes, so right now power brands would be close to 60% of the business, and 25% would be specialty, and the remaining would be the emerging brands when it comes to revenue. On the EBITDA side, the lion's share of the EBITDA today comes from the power brands because they are very large scale and they are throwing up free cash flows. We are investing heavily on the specialty retail part, which is finally coming off scale. And we will see the specialty retail and emerging brand parts of the portfolio materially contributing to the bottom line from next year onwards.
Do you see some of your specialty retail brands graduating to power brands in the current year itself?
So we definitely have some very large growth that has come in. For example, we have a beauty concept called Sephora, which is doing very well in the markets. Even in Q3, it has grown 40% year on year, and we believe that momentum to continue. So a brand like Sephora, definitely we look at that becoming a 500 crore sort of opportunity in the years to come. Other concepts like Calvin Klein and Gap are also rapidly scaling up. They've hit the multi-100 crore mark. Our specialty value retail format Unlimited will be nearing 1,000 crores next year. So these are all becoming large, and yes, you are right, one could think of reclassifying them as power brands in some time.
Okay, I'm sure you were expecting this with Sephora. I mean, the launch was big bang, and it has such a big fan following here in India as well. But I want to understand, what are you doing in the online marketplace? So, what kind of investments are you making there? As a percentage of sales, what is it currently? And how are you planning to drive that part of the business?
So we are very excited. As you know, the online channel is seeing exponential growth. A lot of consumption is moving online, and as a company, our ambition is that we should have amongst the largest market shares of the online fashion market. Our third-party part of the business, which is very large today, it is almost 14% of our overall revenues, which is where we sell through third-party.coms. That is scaling up rapidly. This year, we have grown at upwards of 60% year on year. So it's seeing rapid growth. Our brands are definitely, the casual brands are very popular in the online space, so that's scaling up. The other bright spot for the company is our own omni-channel efforts, and we have seen very huge growth there. In fact, in Q3, we saw 6x growth in our omni-channel efforts over last year. And in the years to come, we believe at least 15-20% of our online business will be our own controlled omni-channel. So between our own omni-channel efforts and third party, I think we will continue to grow the fastest in the online channel. Perhaps next year itself it could account 17-18% of our overall business.
Oh.
Okay.
But if it's 17-18% of your overall business, what about margins? I mean, do you get better margins in online sales, and would that affect your blended margins in any way?
So online is a profitable channel. It is in line with our wholesale channel profitability. So in that sense, it should not negatively impact our bottom line. It's a strong bottom line channel for us.
Okay. More generally, how much would the expense on promotions be? And do you see that being more than last year, eating into margins, or would they be measured?
So, this year we had indicated to the market that we would be aggressively investing in marketing for some of our concepts like Unlimited. And we had said that that would create a little bit of negative operating leverage. But I think after the strong investments we have made this year, next year there should not be a negative operating leverage as far as investments in brand building go. For mature concepts, in our business, the brand building accounts for close to 5% of overall net sales. So next year, there should not be a negative operating leverage on marketing.
Okay, all right. Kulin, we'll leave it at that. Thank you so much for joining us, and all the best with the listing.